So, Greg Fox, the licensed insurance salesman who lies his ass off on the radio each week, lying by omission, presenting straw man arguments, etc., I've discovered he has switched over to another radio station, AM 870, to run his infomercials, which are thinly disguised as radio shows. And when you listen, you can clearly tell that this is a one-sided, like a sales presentation for index annuities. And he's obviously fishing for naive investors because he has, among other things, an 800 number that he wants you to call him at when he gets off the air. Now, Greg Fox claims that he's retired, even though he just renewed his life-only license until 2019, and even though, as far as I can tell, his company has a physical business office space address in the city of Orange, and even though his company just filed their annual statement of information stating that nothing has changed since the last filing, which describes the type of business as insurance sales. Again, index annuities are insurance products. So how is he retired if he's not retired? And if he is, in fact, not retired, then why do you think he would say that he's retired? Clearly, he wants people to drop their guard, to believe that he has no conflicts of interest, and then once he gains your trust, he or his company can then sell you index annuities after he's been puffing them up. Otherwise, do you really think he's doing this for charity? Have you heard the disclaimer at the start and end of his infomercial?
This show furnished by Gregory L. Fox Insurance.
Wait a minute, isn't that a for-profit corporation? I want to know, how is he recouping all the cost of that expensive airtime if he's not selling anything?
David's radio promotion says that he doesn't sell product, he finds solutions. Folks, when somebody is advertising promotions that way, and he's doing it all the time, all day long, you hear that statement. We don't sell product, we find solutions. Please, folks, when somebody starts out with that storytelling, it's time to stay away from them like poison ivy.
So by Greg Fox's own logic, you want to avoid him.
You gotta use some common sense, folks. I'm retired. I got bored, so I'm having too much fun directing people and meeting like the two ladies I met last night, which was terrific fun. I had fun with. I think I was with her about for 2-3 hours.
Woo! Do you really think that he drives out on a Friday night getting stuck in traffic to meet with people in person for 2 to 3 hours for charity? Woo, this is so much fun. Do you not think that at some point down the line, maybe not in his first meeting, maybe the second meeting, he's going to try to arrange to sell them index annuities? Who goes to all this effort? You know who? Salesmen do. That's who.
Going over stuff with them. And they're sharp people.
Actually, these two ladies are naive people because they obviously never did a simple Google search to find out who Greg Fox is in the first place, because had they done so, they would have discovered all of the accusations made against Greg Fox by the California Insurance Commissioner and 7 separate customers of his that I uncovered in my first video review about Greg Fox. And they would have discovered that he was fined $10,000, had his license revoked, given a restricted license. Also, I highly doubt that these two ladies ever asked for both parts of Greg Fox's Form ADV, if he even has one, which would list any conflicts of interest that he might have. Another funny thing about Greg Fox, I hear him attacking Doug Andrews' Wealth Architects, because there's no such designation.
The guys that do the actual selling that have the licenses, they're wealth architects. There's no such designation for that either. It's all made-up nonsense.
Well, speaking of made-up nonsense, there's no such thing as a wealth advisor either.
I've been a wealth advisor for nearly 50 years.
Yeah, it's a phony, made-up designation. And as far as I can tell, Greg Fox has no certifications. Again, the only thing he is, according to FINRA, is a licensed insurance agent. Yeah, that's obviously why he's paying for expensive airtime to puff up these lowly index annuities, all of which earn paltry 1 to 3% returns, according to Chris Wang, a fee-only fiduciary insurance agent.
so expect returns on par with CD.
Also, back when Mr. Fox was on AM 790, he was introduced as a distribution expert.
I'm here with your host, Greg Fox. He's a distribution expert.
What the hell is that, and what does that have to do with investing? Usually when people try to flash their certifications, then they boast that they're a registered investment advisor or a certified financial planner. Greg Fox doesn't have any of these certifications that I can tell. He's a licensed insurance salesman. And he's making some absurd statements on the air. Let's have a listen.
Then we also introduced that 4% rule. If you go back on the podcast, I went over it in detail. The theory came around in the mid-90s. Some financial guy said, well, if you take out 4% of your money in retirement and then adjust it for inflation every year, there's a good chance you won't run out of money. We tried that. You run out of money, folks.
Okay, since 1994, when this rule came about, the 4% rule has worked just fine. If your goal is that you're resigned to earning lowly annuity-like returns, you would invest heavy on the bond side. If you were the unluckiest person in the world in that you started retirement at the worst possible time, January of 2000, this is what happened to the value of your money if you took out 4% per year. In fact, this is starting at $96,000. We took out 4% on day one. The 4% rule has been working just fine. In fact, it's been revised upward. So Greg Fox is just spreading misinformation. He's trying to scare you out of traditional investing in order to puff up index annuities. I think the sleight of hand he's using is to assume that somebody is paying for an expensive asset manager, which of course is a waste of money. That's a straw man argument. You don't need an asset manager to hold and rebalance index funds.
What is it it's going to pay? Now, I hear these numbskulls. I hear this garbage all the time. I don't tie up my money in an annuity. Tell me what you can get out there in an investment that will beat the concept of a certainty of income other than an annuity. Give me a break.
Yeah, with traditional investing, there's no certainty of outcome, but we have 90 years of stock bond return data, which gives us trend lines by which we can make reasonable forecasts, including the Great Recession, including the Great Depression. You don't have to have a guarantee because you put your money in a low-risk allocation, not a high-risk allocation.
Protected. Newsflash. Bonds are down about 8% this year.
Newsflash, bonds were not down at all this year. He made this statement in late 2017. In fact, here's a price return chart of the total bond market index. 10-year treasuries returned 2.8% in 2017.
Because I can show you dozens of different kinds of annuities out there that in the last few years have buried the bond returns and have also been in the top 10% of performance of the market returns.
Bullshit. Okay, right there is a sleight of hand. First of all, the thing that confuses people is the ambiguous word return. And the return word that he's using is not cash surrender value or annualized return on investment. Stocks have in the last 2 years have returned almost 40%, but there is no index annuity on the planet that you can sign up for, earn 40% in 2 years and then cash out. Does not exist. He's clearly talking about income-based, or sometimes it's called accumulation value or protected benefit value, interest crediting, or maybe roll-up rate. This is a fictitious value. So whoop-de-doo, there's annuities that have income bases that double after 10 years. That's merely a basis for determining income payment rate at a later date. And if that income base grows a lot, guess what? You're going to get a lower income payment rate. And in today's low interest rate environment, if you want to cash out, you're going to get a return on investment of between 1 and 3%. So that's point number one. Point number two. So what if bonds have been sluggish in the last few years? Stocks have been on a tear. You own bonds and stocks. And nobody can predict the future direction of the bond and stock markets. That's why you own stocks and bonds together. One of these days, one of these years, stocks are going to go sideways or turn south. Then guess what? Bonds will soar. And number 3, what Greg Fox isn't telling you is that index annuity caps are tied to the interest rate environment. Rates are low now. Bond returns are low. So are index annuity caps. That's why index annuities are only returning 1 to 3%.
Is there a place for them? Absolutely yes, in everybody's plan. Because it's the only thing that can guarantee a certainty of income.
Yeah, it's the only thing that can guarantee an insurance salesman a certainty of income if he doesn't sell anything but annuities.
I'm retired.
Oh, that's right. That's right.
Again, I'm not selling him anything.
Right.
I'm just listening to what he needs.
Aha.
And giving him advice away from all of that.
Aha.
Okay? Now, apparently we have a call. We only got a couple minutes. Instead of me blabbering away, let's see if we can put one in here.
Hello.
Hello.
Hi.
Hi.
I just found your program, so it's good stuff you're putting out there, sounds like.
You just found me? That's it?
Yeah.
Oh, man. In the middle of the program or at the beginning?
About in the middle.
Well, at least you're getting some good stuff today.
Yeah. Are you a fiduciary? That's what they call a fiduciary?
Yes. In fact, when it comes to pension-related assets now, by code, you have to be a fiduciary. So everybody is pretty much in that boat now.
So you see the dodge you did there? Number 1, the DOL fiduciary rule only applies to retirement account assets. The DOL fiduciary rule does not apply to after-tax money. And most importantly, the fiduciary standard will not protect you from being sold index annuities. And if you want to learn why, you had better watch this video. But the point is that this caller did not ask the pertinent questions, such as, are you a fee-only fiduciary? And what are your conflicts of interest? How are you recouping the costs of this expensive airtime? He never asked these questions. Also, if Greg Fox is retired, how the hell is he a fiduciary in the first place? A fiduciary is a professional designation.
Sure. But you don't have products to sell, do you?
Well, we do, but I don't sell them.
Aha! So maybe that's his sleight of hand. Greg Fox, the individual, is maybe retired, but Greg Fox's company, which is its own separate legal entity, is not retired. I'm not selling you anything, but my company will when I convince you that you need an index annuity.
In other words, if I run into someone like yourself that's trying to get some direction, first I'll talk to you. Okay, that's what the number is after hours, and I uncover some things and give you some direction, and then maybe put you in a direction where you can get some help. Okay? That's the most important. Now, we're running out of time, but thank you for calling.
Yeah, we're running out of time. I don't want to risk you asking any questions that might really put me on the spot and expose my conflicts of interest. So, yeah, we're running out of time. I'm going to have to cut you off.
First, I'll talk to you.
Yeah, he's so casual, down-to-earth, friendly guy. I don't know. What do you guys think? Let me know in the comments section. Do you think this guy is selling annuities to earn commissions? What do you think?
If they don't have guarantees, you need to run away and call me.